If you're an employee, there's a pretty good chance you've been automatically enrolled into a workplace pension. But have you ever stopped to get a handle on what that means for you and, more importantly, understand what the additional benefits are that you'll enjoy in retirement as a result? If you've been automatically enrolled into a workplace pension, then you're in the right place, because I'm going to explain some of the main features and benefits of your workplace pension by answering 5 of the most common questions that I get asked around workplace pensions, and they are: what is tax relief? Does my employer contribute? Can I pay more in? What funds can I invest in? And what if I die too soon? Now, in this video I touch on quite a few areas that I've done other videos on, which I'll reference up here, but I'll also include links to all of them in the description so you can check them out once you've watched this one. And I've also grouped them together into a playlist in the description and also in the end screen at the end of the video. And if that's not enough, if you make it all the way to the end, I'll reward you with a checklist of all the things you need to find out and where you need to go to get the information to get a handle on your own workplace pension. If you haven't been automatically enrolled into a defined contribution workplace pension because you're lucky enough to be a member of a defined benefit pension like the teacher's pension or the NHS pension or the local government pension, then this video is not for you, and you should do 2 things. Have a look at this video all about defined benefit pensions, but first give this video a like, because I've just saved you a bit of time to go and watch something more useful. All that being said, let's get into workplace pensions. First off, let's talk about the basics. A pension is just something that's designed to provide you with an income in retirement. It has some nice tax advantages to encourage you to save towards your retirement, but that's all it is. A way not to spend your money now when your income is higher, so that you get to spend it later when your income is lower. Your role in pension planning is to make sure your pension is sufficiently well funded at retirement to provide you with all the income you need for your desired lifestyle for the rest of your life. And that's on you. It's your retirement, your pension, and ultimately your responsibility. You can work with a financial planner like me and we'll shoulder a chunk of that burden, but if you choose to do it yourself, then the onus for success is entirely on you. Now, a workplace pension is simply a way of saving for your retirement that's arranged by your employer. In most cases, you don't need to do anything to get involved as long as you meet a few criteria, and more of that in a bit. There's a really neat bit of psychology embedded into it too, but first a bit of history. Auto-enrolment was phased in from 2012 as part of the government's plan to encourage more people to save more money for their retirement. The ever-growing strain on the welfare state has meant that relying on the flat rate state pension alone means that more people will require additional support, as their state pension will not provide the income that they need to sustain their lifestyle in retirement. Now, once you're enrolled into a workplace pension scheme, both you and your employer make regular contributions to your pension pot. Now for the psychology part. If you're an employee and meet certain criteria, you will be automatically enrolled into your employer's workplace pension scheme. The important thing to note here is that this is automatic. That's the psychology bit. If you do nothing, which is what most people do when it comes to pensions, if you do nothing, you automatically get a workplace pension. You can't do anything about it. If you don't want to be enrolled in your workplace pension scheme, then you have to physically opt out, but only after you've been automatically enrolled in. Taking action is not most people's default position. I'd also add that you should strongly consider both the short-term and long-term implications before making the drastic decision to opt out of your workplace pension. By opting out, you're most likely putting your retirement on a worse footing because you're turning down free money from your employer and possibly the government in tax relief, as well as potentially paying more in income tax. But here's the second bit of psychology. If you opt out, you automatically get re-enrolled every 3 years, and you'll need to opt out again. If you're an employee, it's much more effort not to get a workplace pension than it is to get one. Now, automatic enrolment is a good deal. So how do you get it? Well, in order to be automatically enrolled, you need to work in the UK, be aged between 22 and state pension age, and earn more than £10,000 a year for the 2024-25 tax year. If you're under 22 or over state pension age, or if you earn less than £10,000 but more than £6,240, your employer doesn't have to enrol you, but you can elect to join the pension scheme, and your employer cannot refuse, and they must make contributions on your behalf. If you earn less than £6,240, you can opt in, but your employer is not obliged to pay into your pension for you. So that's a whistle-stop tour of workplace pensions and automatic enrolment. Now for the detail. One of the key benefits of a workplace pension is tax relief. This means that some of your money that would have gone to the government as income tax goes into your pension pot instead. Essentially, the government is boosting your savings. If you're a basic rate taxpayer, for every £80 you contribute into your workplace pension, or your own private personal pension for that matter, the government adds an extra £20, making it a total of £100 in your pension. If you pay tax at 40% or 45%, you might be able to claim higher rate tax relief too, but it all depends on how your employer deals with your pension contributions. And they can choose from two options. The first option is known as relief at source. Here, your employer calculates how much income tax you should pay and deducts that amount from your salary. They then deduct your pension contribution from this amount after tax and pay that into your pension. This means your pension contribution is deducted from your after-tax earnings. The pension provider then claims the tax relief on the amount you've contributed to your pension back from HMRC on your behalf, and it's automatically added into your pension. So if you're a basic rate taxpayer, then £100 of your salary is taxed at 20%, leaving you with £80. If this is paid into your pension using relief at source, then the government will add back in the 20% tax you've already paid, making the total contribution back up to £100. The problem with this method is for people who pay tax at 40% or 45%, they're only getting 20% tax relief automatically on the contribution if they don't complete a self-assessment form or they don't include their workplace pension contributions on their self-assessment form. So if you're in this category, you're entitled to additional tax relief of an extra 20% or 25% on top of the 20% basic rate tax relief added into your pension by the government. This is given by way of a tax rebate or an amendment to your tax code, so you pay less income tax going forward. But either way, you'll need to claim it yourself. The second option for employers to pay into your workplace pension is known as the net pay arrangement. Here, your employer deducts your pension contribution amount from your salary before calculating your income tax liability. This makes your income tax bill lower, and it means higher rate taxpayers and additional rate taxpayers won't need to reclaim any additional tax relief from HMRC on their self-assessment form. The additional tax relief will have already been accounted for in their salary. So £100 of pension contribution is deducted before the income tax calculation. The £100 is paid directly into the pension and no tax relief is added back in because no income tax has been paid on that contribution. The taxable salary is £100 lower and there's £100 in the pension, so the correct amount of tax will have been paid regardless of whether you're a basic, higher or additional rate taxpayer. However, if you're a non-taxpayer, you will miss out on the 20% tax relief you are entitled to using this method of payment. It's worth reminding you that everyone under 75, all the way down to newborn babies, are entitled to make pension contributions of up to £3,600 per annum, including the basic rate tax relief, irrespective of their earnings. And while we're on the subject of how much you can pay in, because the tax relief on pension contributions is so attractive, the government limits the amount of tax relief that an individual can claim in any one tax year. Now, I've done a video about the annual allowance here, but There's a couple of other annual allowances that further restrict the amount that can be paid into the pension, and they'll be listed in the description under annual allowances. If you don't know which method your employer is using to contribute into your workplace pension scheme, you should definitely ask them. If they don't know, your workplace pension provider will definitely know that information. Your employer also puts money into your workplace pension. This is like getting free money. The amount your employer contributes varies, but it's typically a percentage of your earnings. The combination of your contribution, your employer's contributions, and the tax relief adds up over time, helping you build a substantial retirement fund. There are a few different ways an employer can choose to determine how much they pay. Typically, this is a minimum of 8% in total and 3% employer contributions of qualifying earnings, which is the salary between £10,000 and £50,270, which is the threshold for higher rate tax. If you don't know how much your employer contributes, you should definitely ask them. These are the minimums, but some employers pay more. For example, they may base contributions on the whole of your salary, not just the bit between 10 grand and 50 grand, or pay more than 3% minimum employer contribution. Again, ask if they do this. You never know, they might surprise you. So the employer pays at least 3% of the qualifying earnings as a minimum, leaving 5% left for the employee to fund. If the payment method is relief at source, then it's actually made up of 4% employee contribution and 1% tax relief back from the government. If it's via the net pay method, then the full 5% is deducted from the salary and paid into the workplace pension scheme before the calculation of income tax on the salary. Almost certainly yes, you can just ask your employer to increase your payment. However, a better method might be salary sacrifice, because your employer will pay less employer NI and might pay some or all of the NI saving into your pension too. This can also be a good idea to discuss with your employer around performance review time and salary increases or bonuses. It's an attractive option for employers. And here's why. Salary sacrifice is a special contractual arrangement where you agree to reduce your salary in exchange for your employer paying the equivalent amount directly into your pension. Imagine you want to pay £100 additional into your pension using salary sacrifice. Currently, that £100 of salary is taxed and liable to employee NI. With salary sacrifice, you agree to reduce your salary by £100. As you never receive the £100, you don't pay any income tax or employee NI on it. Instead, your employer agrees to pay the £100 directly into your pension as an employer contribution. This means your employer doesn't have to pay the employer NI on the £100 of salary that's been redirected into your pension under salary sacrifice. That saves them employer national insurance at 13.8% under the current NI rates. Some employers often agree to pass on some or all of that 13.8% employer NI saving onto their employees in the form of additional pension payments. The best case scenario would be £113.80 for every £100 of salary sacrifice. This is still cost neutral to the employer. It's worth noting that in the October 2024 budget, it was announced that employer NI was increasing from 13.8% to 15%, and the point at which it becomes payable will be reduced to £5,000, down from the current threshold of £9,100. This means more companies will be paying a higher rate of NI on more of their employees' salary from April 2025. This will inevitably make pension funding through salary sacrifice a much more attractive proposition to employers moving forward. So I've outlined the benefits of salary sacrifice: lower national insurance and income tax for you and lower national insurance for your employer. But there are a couple of drawbacks that you should be aware of just in case. Firstly, a lower salary on paper could affect things like mortgage applications or salary related benefits like death in service life cover through your employer. And secondly, there could be an impact on any state benefits. A lower salary might reduce your entitlement to state benefits and statutory payments like maternity pay. Before agreeing to salary sacrifice, it's important to check with your employer about how it might affect your specific situation and benefits package, and what they'll do with the savings of employer NI. Well, you can choose from any of the funds on offer inside your workplace pension. Many employees don't even know who their workplace pension provider is, let alone what funds they can choose. If that's the case, you should definitely find out from your employer who the pension provider is, and they should be sending you statements at the very least. There's probably an online portal you can log into to see your pension value and be able to find a list of all the funds that you can choose to invest in for your pension. What's wild is that most people who set up their workplace pensions have been contributing them for years but never looked at it. And they have no idea what funds they're actually invested in. But it's worth noting, and we're back to that psychology bit again, if you don't choose a fund to invest your pension savings into, you'll automatically go into the default fund. It won't remain in cash for years, getting ravaged by inflation. Now, I've done a video here all about inflation being the biggest risk we all face in retirement. The second thing is that the default fund might be a lifestyle fund that automatically reduces your pension's investment risk as you approach your retirement day. But there's a few issues with accepting this default position. Firstly, retirement date. How do they know what that is? Do you know what your retirement date is? Have you told them? I've done a video here about the difference between state pension age and retirement age and the age that you start to take your pension withdrawals. They don't have to be the same date. The second issue assumes that you'll want to buy an annuity at that age. So you want the most amount of money in your pension fund at that point. So a lifestyle fund aims to reduce the risk in the run-up to your retirement age, whatever that means, by moving out of equities and increasing corporate bonds and gilts, thereby reducing short-term investment volatility in the run-up to that date in case the markets go down sharply. But that might not be the best option for what you plan to do with your pensions. The final point is that at the point you retire, you might have another 25, 30, 35, 40 years left on your pension payments. If you don't buy an annuity, you almost certainly will want to have a bit more investment risk if you've got that sort of time horizon. The point is that lifestyling is a one-size-fits-all approach to pension investing, and this may be a suboptimal outcome for your plans for your retirement spending. Now, I've done a video here all about long-term investing and a different way you can think about investment risk, and it's really worth a look. So workplace pensions will have a range of funds with differing levels of investment risk for you to use, and you should choose wisely rather than relying on the default fund. I've done a video about how much investment risk to take here. If you die, your pension can pass to whoever you want. Up until April 2027, it's free of inheritance tax, but following the October 2024 budget, pensions will become part of your estate liable to inheritance tax. The tax treatment of inherited pensions depends on the age of the scheme member when they die. If you die under 75, under current legislation, all withdrawals from an inherited pension are free from income tax. If death occurs after 75, inherited pensions are taxed as taxable income in the year of any withdrawal by the beneficiary. Now, there's an important aspect of your workplace pension that you shouldn't overlook, and that's completing your death benefit nomination form. This form lets you specify who you want to receive your pension benefits if something happens to you. It ensures that your loved ones are taken care of and that the residual money left in your pension when you die goes where you want it to. Many people either don't do this or don't update it, particularly pertinent if you've not updated your death benefit nomination following a divorce. Chances are you don't want your ex-partner to inherit your pension. It's a straightforward process. Your pension provider will have the form. You simply need to fill in the details of your chosen beneficiaries. This step is crucial for giving you peace of mind and ensuring your wishes are going to be respected if you pass away. So just before I share the checklist as a reward for getting to the end of the video, just a reminder that we're looking to grow this channel so more people like you can find our stuff on YouTube. So if you found this video helpful, I'd be immensely grateful if you could hit that like button and subscribe to the channel. Most of our video viewers aren't subscribers, so you'd be really helping me out and you're not going to miss out on our next video. So just to summarize, with your workplace pension, you benefit from tax relief, employer contributions, tax efficient additional payments, lots of investment choices, and decent death benefits. By staying in your workplace pension, you're taking a big step towards securing your financial future. If you have any questions or any comments on this video or suggestions for future videos, leave them down below. And as promised, your reward for getting to the end of this video is my 9-point checklist for your workplace pensions. Questions to ask your employer: who is the workplace pension provided by? Are the contributions paid using the relief at source or net pay arrangement? Will your employer offer salary sacrifice, and will they redirect some or all of the employer NI saved into your workplace pension? What is the percentage basis for employer and employee contributions? Questions to ask your pension provider: what funds can you choose? What funds are you already invested in? How can you switch funds? Have you completed the death benefit nomination form? And if not, how do you go about that? And what retirement age are they working with? Remember, a little forward planning today means a brighter, more secure financial future tomorrow. Here's a link to the playlist I mentioned at the start of the video, and you can subscribe to my channel by clicking on this little round button here. And if you do, you'll be the first person in more than 200 videos to actually click on it. Thanks for watching, and I'll see you in the next video.